Chapter 2 is about asset classes and financial instruments. And we discussed earlier that the three broad asset classes are fixed income, equity, and derivatives. And then there's a variety of securities within each of those. So under fixed income, in that asset class, it's made up of money markets and capital markets. The money market, and this is an important part to know about this, is that money markets are typically very short-term, very liquid, low risk, and are typically large denominations, like $100,000 units. So many of them are out of reach of the individual investor. Now, a security within that group is Treasury bills. Treasury bills are issued by the federal government, and they're issued at various maturities, 4-week, 13, 26, or 52-week maturities, and they're sold at a discount. So they can be bought directly from the government or in the secondary market, but they are sold at a discount. The difference between what you pay for it and the value at maturity represents the earnings on a Treasury bill. Now, they are considered, as you're aware, to have no default risk or to be risk-free, and they're very liquid, so they can be converted to cash very easily. Denomination, and we're going to see this type of a format on various types of securities as we move through this chapter, and you can compare them based on these items. Treasury bills are denominated typically in either $10,000, but they can be purchased in $1,000 units as well. In fact, Treasury bills can be bought directly from the federal government in units as small as $100. So I believe the most common denomination is 1,000. The book says 10,000, but anyway, they can be bought in units of 1,000, 10,000, or even down to $100. Another investment considered part of the money market or fixed income are CDs, or certificate of deposits. They're issued by banks or depository institutions, and as you may know, any of us can go to our local bank and purchase a CD. So any denomination, any amount we want to, it's like a savings account. Any amount we want to put into a CD, we can. However, the larger ones are more marketable or more liquid. We can sell them more quickly. So, CDs at the individual level at the bank, if you cash them in before they mature, you're going to take a discount. You'll have a penalty. However, for businesses, shorter term CDs, particularly if they're larger, can be sold. Also, an issue with CDs, anytime we put money in a bank, it has FDIC insurance. So, and that FDIC limit is currently $250,000. So the first $250,000 put in a CD or any other bank account is guaranteed by the federal government in the event that bank were to go bankrupt. So that is certificates of deposit. You'll remember from other classes that the Treasury bills, T-bill rate, or Treasury bills are considered the risk-free investment. And this chart compares T-bill rates, risk-free, versus bank CDs, which you think of as being very low risk. However, in times of severe market stress or panic or fear, then we see the difference between those two rise. So during the financial crisis of 2008, CDs, banks had to pay higher rates in order to attract investment capital, because investors fled to treasury bills because they're safe. And that has happened throughout history, going back to OPEC. You may not recall or be aware of what the OPEC crisis was, but there was a war between the oil-producing countries and Israel, and America supported Israel. So OPEC initiated an oil embargo and would not sell oil to the United States. So that created fear and panic in the markets. And as safe as CDs are, a lot of money moved to treasury bills, so bank rates went higher, so the spread between the two increased in each of these periods of market stress. Another security in the money markets is called commercial paper, and commercial paper is issued by corporations, usually large, credit-worthy corporations. They typically are rated by at least one rating agency like Standard & Poor's. Denominations is typically a minimum of $100,000, so this is a space of large investors. Maturities are usually short, are usually only 1 to 2 months. There is a secondary market for commercial paper where already issued paper can be traded, so it's usually pretty liquid. Now, commercial paper is typically unsecured. There's no collateral, but because of its short-term nature, it is considered to be very low default risk. It's typically unsecured, but there is something called asset-backed commercial paper, where the corporation promises collateral to back up their commercial paper. And interest is discount, so it's the paper sold at a discount, and then the full value of the paper, say $100,000, is paid to the investor on maturity. A banker's acceptance starts out as an order to a bank by one of their customers, like a company, to pay an amount of money at some future time. It's usually 6 months or within 6 months. So then it becomes like a post-dated check. So when the bank accepts that order, it is then, once the bank accepts the order, they take the responsibility to make that payment. At that point, the banker's acceptance becomes a marketable security. It can be sold, and it allows the bank customer to use their banker's credit. Once that has been accepted, then the bank stands behind it, so you've got the credit rating of the bank promising to make that payment at some later point. Usually bankers' acceptances sell at a discount as well. Eurodollars is a term you need to know, and so Eurodollars are deposits, like imagine in a bank account outside of the United States, but still denominated in dollars. So if there were a bank account in London that was denominated in dollars rather than pounds or euro, then that would be considered Eurodollars. Those accounts are outside the reach of the U.S. banking system and the Federal Reserve. They're usually denominated in large amounts, like over $100,000, so not the space of individual investors so much, but they do pay a little higher interest than deposits in the United States. Federal funds is a term that you should be familiar with. So banks that are part of the Federal Reserve System are required to maintain a certain amount of reserves at the Federal Reserve Bank. And if they fall below that level, they have to borrow money overnight from another bank in the system that has an excess. So this overnight lending, just to maintain the reserve requirement, is called the Fed funds rate. And this is the interest rate. When you hear that the Fed raised or lowered rates, this is the rate they're talking about, the Fed funds rate, which is just an overnight interest rate for overnight loans between banks, from one bank to another. But it's a key interest rate because it tends to lead other rates throughout the economy, whether it's mortgage rates, CD rates. So it indicates where the Federal Reserve wants to move the economy. And they have other tools besides the Fed funds rate to tighten the monetary supply or to stimulate the economy. So others know if the Fed lowers rates, they are becoming more lenient, and so therefore other rates tend to fall as well. Obviously, the Fed funds rate only applies to American banks in the Federal Reserve System. There's a similar rate in London called LIBOR that is the rate that large banks in London lend to one another. But more importantly, the LIBOR has been a benchmark rate that many loans are based on, even in America. So a variable rate loan in America might be based on LIBOR plus 0.5%. And many many loans, commercial loans, have been anchored by LIBOR. There is a very interesting story about a scandal, if you like scandals, in the book called The LIBOR Scandal in Chapter 2. Suggest you read that the London banks were manipulating the LIBOR rate to their advantage and created quite a scandal. And so the search is on for a replacement to the LIBOR. It's supposed to be phased out by next year. So anyway, read about the scandal, very interesting. And it highlights the fact that, the large incentives for companies, including banks, to make money sometimes motivates them to do things they should not do. And this is an example of that. So read about that scandal. We're going to skip over repurchase agreements and reverse repos. So there's enough here under money markets that we'll just leave those aside. We'll also leave aside brokered calls. Money market mutual funds are funds that hold a variety of money market instruments. They may hold in their fund treasury bills, CDs, commercial papers, banker acceptances, and so on. And so the idea, of course, is to diversify risk. They're thought to be very, very safe, but during the financial crisis of 2008, they also had a crisis. They're usually denominated, the money market mutual funds, in $1, but they went below $1 because of fear around the financial crisis. So, when panic sets in, or fear, it's really contagious and can run to even very safe instruments. So that's really what happened here. And the U.S. Treasury stepped in and offered to insure all the money market mutual funds just to stop the panic. And that's what happened in 2008. We're going to mostly skip over the next few slides about instrument yields. Just be aware that some instruments assume a 360-day year and some assume a 365-day year. So that ends up creating small differences in interest rates based on how many days are in the year. Okay, that leads us to the next category of fixed income, which is capital markets. We've covered money markets and the various securities within money markets. Now we're going to talk about the capital markets under fixed income. The capital market is the part of the financial system that's concerned with raising funds for long-term investment, whether it's a corporation or the government. Both raise money to be to grow, for growth. In the government's case, they may raise money for military or really, in essence, for shortfalls in the budget. but the budget covers, of course, roads, military, and so forth, social services. And the capital markets are typically longer term payback on the corporate side. And the government side, we're talking about bonds and notes. As you know, notes have terms of up to 10 years, bonds are over 10 years. Both may be issued in denominations of $100, but they're much more common in $1,000, and especially for trading. Both bonds and notes make coupon payments. The interest is called a coupon payment, and they're paid twice a year, so they're considered semi-annual. Risk, government issues are considered risk-free as far as getting your return of your interest and principal. However, there is some maturity risk. You've got an inflation risk that maybe the value of the money you get back in 10, 20, 30 years may be less. The purchasing power will decline with time. So there is a risk that the interest payment or the interest on a bond or a note is less than inflation. So that's why Treasury bills are considered risk-free, because not only are they backed by the government, but the maturities are very short. So you have less exposure to inflation. And also taxation issues of the federal government are taxed by the federal government on a tax return, federal tax return. There's also a newer product by the government called inflation protected securities. They're known acronym of TIPS, and the principal, the issue amount, is adjusted based on changes in the consumer price index, which is the proxy, of course, for inflation. So there is a pretty wide concern about all the monetary expansion for COVID. For COVID, the the spending of the federal government has gone up dramatically. So anytime there is more money in an economy, the amount of money grows faster than the total value of goods and services, there's a potential for inflation there. So because of that concern, TIPS are very popular. Part of the bond market are what's called agency issues. So these are government agency issues. They list here some home mortgage related ones, and those acronyms stand for Fannie Mae, Freddie Mac, and Ginnie Mae, and then the federal home loan banks. So these are bonds the federal government floats to provide funding for loans, mostly home loans. Now, interestingly, these acronym-related agency issues, considered agency issues, but they're really not agencies of the federal government. They're what's called government-sponsored enterprises, GSEs, but they do have the implied backing, at least, of the federal government. And in fact, we saw in 2008, the federal government took over Fannie and Freddie. So investors have always assumed the federal government would step in case of a failure, and in fact they did. So default risk appears to be very low, because you hear these days about systemic failure. We've had bank bailouts that the federal government felt, the Federal Reserve, the Treasury felt that if these large banks were to fail, it would have a domino effect throughout the entire economy. Well, if they feel that about privately held banks, and certainly these government-sponsored enterprises are considered to be too big to fail. So I believe we have little to fear that they would ever go bankrupt. So those were issues of the federal government. Now we're going to look at municipal bonds. So these are municipals are bonds issued by cities, counties, states, not the federal government. So municipal bonds are taxed differently because they are not subject to federal income tax. So for that reason, we have this at the bottom of this slide, this adjustment you've seen before of how to give the tax credit, recognize the tax credit for a municipal. So let me restate that. Since municipals are tax exempt, if we want to compare them to a corporate bond, for instance, that is taxable, we would need to adjust the interest rate paid on the corporate or the federal government issue by multiplying it by 1 minus the tax rate to get the after-tax return on that government or corporate. And then we could compare it to a municipal bonds. Example is probably the best way to illustrate this. So I penciled in this solve right here at the bottom, that if a corporate or a U.S. government yielded 1.25%, then we plug that into our formula. That's the taxable rate. Multiply it by 1 minus the tax rate, which is 20% right here. And when you do this math, you would get a after-tax yield of 1%. So that would be a way you could compare a taxable bond to a non-taxable. Talking about government issues, now we're going to talk about corporate bonds for a second. There's investment grade, which are AAA rated, but the rating agencies, either S&P, Moody's, or Fitch, are all rating agencies that look at the ability of companies to make good on their interest and principal repayment. Speculative grade bonds are also called junk bonds. You've heard of that, right? Boy, that's pretty rough there, but junk bonds. Then we've got mortgage-backed securities, and they are backed by mortgages, obviously. So the payments pass through to cover the return on the mortgage-backed securities. The collateral, of course, is the mortgages themselves. They usually conform, most mortgages conform to Fannie Mae or Freddie Mac underwriting requirements. That is how much home buyers have to earn, their loan to debt to loan ratio, and their credit history and so forth. That would be the debt to income ratio. That's what that's called. And one of the benefits of mortgage-backed securities is over the very long haul, housing prices do tend to rise, so the value of the collateral rises, so that's a benefit to these mortgage-backed securities. So this video has gotten a little longer than I like for them to be, so we're going to cut it off here, and we'll pick up in the next video to finish this chapter.